Okay, everyone, Assalamu alaikum and welcome to the SBR's Strategic Business Reporting Revision session. And today is day 3 that we're going to start. And in the first 2 days, day 1 and day 2, we have covered the area of consolidation. And the day 3 and day 4 is more about the accounting standards. And we can have some discussion about the current issues and the framework as well. Okay, so what's today's target? And today we are going to start with the accounting standards. And if I just write down today's target, we mainly have 3 accounting standards as today's target. We are going to cover IAS 19, we are going to cover IFRS 15, and we are going to cover IFRS 16. So these 3 are the main areas that we're going to cover in today's session, which is day number 3. And in day number 4, we are going to cover the financial instruments, which is IAS 32 and IFRS 9, and we are going to cover the area of deferred tax, which is IAS 12. So these are the main areas that we are targeting in day 3 and day 4 to cover. Walaikum Assalam, Muhammad Lameen. Yes, Iftimaja, I'm going to send. Okay, so let's start with the first topic of IAS 19 for today's session. When we talk about IAS 19, we in total have 3 types of benefits, or we can say 4 types of benefits. The first the one is the short-term benefit. The second one is the post-retirement benefits. The third one is the other long-term benefits. And the last area is the termination benefits. These are the 4 areas that are mainly covered in the topic of IAS 19. But the most important of all these is the post-retirement benefit. This is the most favorite area of the examiner, because the remaining area, short term has been asked once, other long term has been asked once, termination has not been asked yet, and majority of the time the topic, the area being asked is the post retirement benefit. So that is why the importance of this is comparatively higher than any other area. So if we start from the post retirement benefit, in post retirement benefits we have 2 types of the plans. One is the defined contribution plan, and the other is the defined benefit plan. So in total, there are 2 types of the plan which we are going to discuss. One is the defined contribution plan, and the other is the defined benefit plan. Now we should be aware 2 types of areas: the identification of these 2 and the accounting of these 2. Even the identification was last asked in 2010. After that, the identification has not been asked. Since then, the examiner is focusing more on the accounting. So we will also start from the basic accounting, but we will have a basic discussion, a small discussion on the identification as well. So basically, what's the scene exactly? Normally, we are a company that actually makes a fund where we contribute an amount every year, which the fund actually invests, and earns return on. Now, when the employee retires, this amount is paid to the employee, which we call is the benefits paid. We pay the benefit from the fund to the employee. this is a normal procedure that we should be following. Mohammed Lamin is asking, what about the articles you talked about yesterday? Mohammed Lamin, the articles are supposed to be read at home uh, because that is a simple area. We have already discussed that in the regular classes. So it would be preferable to read that area on your own. However, we can have a discussion. However, we can have a discussion in the cryptocurrency at least, because that would require some understanding for the students. Ajmal, I've already shared the webinar of day 2 on the WhatsApp group. I've shared both the links of day 1 and day 2. And even if you find it difficult, you can simply search my name on the YouTube, and you are going to find a YouTube channel by my name. Over there, we have an SBR Revision playlist available where you can find the lectures. Yes, Jesse, I have to share the mock. The mock is ready, and it is just to be shared on the group. Cindy is saying, sir, article on PNL OCI. Okay, Cindy, let's look into that in a while. Let's start first with today's target. So this is an overview that the company contributes into the fund. No, Hina, the MNN YouTube channel is not mine. That's someone else who simply downloads the lectures of multiple teachers, and they simply upload it on their own channel to earn some money um, from the advertisements. So my channel is simply by my name. You can easily access that, and there are no advertisements on my channel because the objective is not to earn. The objective is to share the knowledge with other people. Okay, Bibi Fatma, I will share that as well. So now the company makes a contribution and and the fund invests, earns return, and then these are paid in by the name of benefits to the employees. Now the question is, what if the return becomes a loss? What if the amount invested by the fund um, incurs a loss? Who's going to bear the loss? Will the company bear the loss, or will the employee bear the loss? Say if the company bears the loss, this is called a defined benefit plan. And if the employee bears the loss, this is called the defined contribution plan. If the company is bearing the loss, we call it a defined benefit plan. And if the employee bears the loss, we call it a defined contribution plan. So we can say that in case of a defined contribution plan, the risk belongs to employee. So the company is only liable. The company is liable up to the extent of contribution only. Once the company has contributed, the company has no further legal or constructive obligation. Then we are going to call that a defined contribution plan, which also means that investment and actuarial risk belongs to the employee or the third party. The company is never going to bear the investment or the actuarial risk. And normally in such type of plans, the contribution actually depends. In fact, the benefit actually depends on the assets in the fund. So if these things are there, we call it a defined contribution plan. If the liability is not limited, if the liability is not limited up to the extent of contribution, or the investment or actuarial risk belongs to the company as well, then we call it a defined benefit plan. So we can simply say if the plan is not a defined contribution plan, then it is a defined benefit plan. So the rule is simple. Simply check whether it's a contribution plan or not. If it's not, it's a defined benefit then. If it's not a defined contribution plan, then it's simply a defined, if it's not a defined contribution plan, it's simply a defined benefit plan. Getting this, everyone? Okay, so that's great. So this is the identification which was last asked in the 2010 examination, and since then it has not been asked by the examiner. So its more focus is on the accounting. And when we talk about the accounting of defined contribution plan, that's pretty simple, that whatever amount the company is contributing is simply recorded as an expense. Whatever the amount is contributing, the company is contributing, is simply recognized as an expense. And any amount which is unpaid, so any unpaid contribution is simply recorded as a liability. So the treatment of defined contribution plan is quite simple. Okay, so Ahmed Nabi is saying, what was actuarial? Can you refresh on this? I will refresh in a while, Ahmed Nabi. Because once we start the details of the defined benefit plan, then you will be able to understand it better. Okay, so now let's start the accounting for the defined benefit plan. In defined benefit plan, what actually happens that the company records a promise, records a liability about the amount that is payable to the to the employee. So company records the liability for the benefit payable to employees. Plus, because the company has also made a fund and is making investments into that, for that we record it as an asset, because that will be used to repay the liability of the company. So we are recording two things. On one side, we are recording the liability that is payable to the employees, and on the other side, because we are recording an asset, which is the fund which will be used to pay the liabilities of the employees. So now the liability that we record is recorded at the present value because it is going to be repaid after many years. And the asset that we record is recorded at the fair value. So what we actually do, we simply record a table where we make two columns, a plan asset and a defined benefit obligation. So we record a liability and a plan asset and a net liability. Liability which is simply DBO minus the plan asset, the net liability that the company has to pay on its own. So now we first record the DBO, the plan asset brought down, And because the DBO is a present value, we need to unwind that. And because the fund has invested the amount, it has to earn the return as well. So we simply record an interest on this. So let's say whatever interest is given, we are going to apply that interest rate on the brought down of the plan asset and the brought down of the DBO. So let's suppose the brought down of the DBO was 100, plan asset was 80, so the net liability was 20. So 10% will result in the interest cost of 10 and interest income of 8. So this 10 million is basically unwinding of the present value. While this 8 million we call is the minimum interest return, minimum return required by the company. So this is representing the return that the company wants to earn. This is not the actual return. The actual return may be higher or may be lower than this. The next thing is that the benefit that the company has promised to the employees, which is the liability, this is recorded as an expense over the employee's service period. This is recorded as an expense over the employee's service period. So whatever expense we are recording every year is called the current service cost. So let's say the current service cost is $40 million. So it is not going to affect the plan asset. That will only be a part of the DBO. So the net impact of the interest is 2, the net impact of the current service cost is 40. Similarly, if there is any change in the plan, we call that a past service cost. Any change in the plan will actually change the liability as well. So that change in liability is called past service cost. Change in the liability is called the past service cost, because this relates to the past period, the service of the employees which has already passed by. So this past service cost, let's say $30 million, is also added in the DBO, and it is not going to affect the plan asset. Similarly, if there is any curtailment in the plan, then that curtailment is deducted from the DBO, and if the curtailment is with settlement, then the settlement amount is deducted from the plan asset as well. This curtailment and settlement will be discussed in a while. So the net amount is called the gain or loss on curtailment or settlement. So apart from current service cost, we are recognizing the past service cost, plus we are recognizing the gain or loss on the curtailment or the settlement. Getting this, everyone? Okay, Jesse is clear, but T is not clear. What about the others? Imran is clear. Okay, so that's good. Once we move forward towards the question, then obviously the concepts will be more clear. T is saying about the gain or loss. We are discussing the gain or loss in a while. Hafiz has got it. Ajmal, we won't be required to calculate these. We will only be incorporating this into the financial statements. Cindy is saying why curtailment is negative. Okay, let's first explain the past service cost a bit in more detail. Basically, let's suppose that if we say to the employee that if you work for 20 years, we are going to give you 10% of your last salary as a pension until you are alive. Now, this is the benefit that we are going to pay in actual to the employee. This benefit should be recorded as an expense over 20 years, which we call is the current service cost. So let's suppose we have an employee who is going to have a last salary of $500,000 per annum, an estimated amount. So we are expecting him to get $50,000 from us. And let's say we say he's going to live for 15 years. So this means that we are going to pay him $750,000, which is an expense for 20 years. So every year we should be recognizing $37,500 as an expense. Now let's suppose after 10 years, when the liability was recorded as $375,000, the company changed the plan and they said, okay, you are going to get 15% of the last salary. So the amount has now been changed. So 50,000 into 15% will be $75,000. And that into 50 years will give us a value of, let's use a calculator for that, 75,000 into 15, which is 11,250,000. Sorry, 1125 and then 000. Now, ideally, this divided by 20 years should have been the expense of the previous years. So 11, according to the new estimate, it should be 11,250 divided by 20 years, which is 56250. Thank you, Imran. So 56250 should be the ideally expense every year. And 10 years, this should be 562,500. So the change in plan has increased the liability by how much? By 187,500. This is called the past service cost. This is what we call as the past service cost. The change in liability because of the change in the pension entitlement. Getting this, everyone? Those who were not able to understand the past service cost? These calculations are not expected in the exam. This is just to make you understand what exactly is the past service cost. Okay, Hannah has got it. Yes, Cindy, this is expensed immediately. Okay, so that's great. Okay, now let's move forward. Hafiz, I'm going to answer you in a while. Jesse saying, what is definition of past service cost? Jesse, definition can be said to be the change in liability. The change in liability because of the change in pension entitlement. Change in liability, this one. Change in liability because of the change in the pension entitlement in the plan is what is called the past service cost. That's great. Law is also clear now. And the next thing that we were discussing was the curtailment and settlement. Basically, what do we mean by curtailment? Curtailment means a substantial reduction in the employees in the plan. If we substantially reduce the employees in the plan, that is called curtailment. And because we are reducing the employees in the plan, this should result in the liability getting debited. So this is going to reduce our liability, which is a debit in the DBO. So this will result in the debit in the DBO. Now, what about the credit side? So we say that the curtailment can be of two types. Either it is going to be with settlement, which means we are going to pay the employees an amount as well, or it is going to be without settlement. Without settlement means we are not going to pay any amount to the employees. So if it's without settlement, then the credit is the P&L because that will be a gain. Our liability has reduced and we didn't even pay any cash. So that will result in a gain being recorded in the P&L. But if we are paying any amount to the employees, in that case, we are going to credit the bank. But ideally, we should be paying the amount from the plan asset. So we are going to credit the plan asset. So if I write the complete entry, the entry is going to be DBO debit, P&L credit in case of without settlement, and DBO debit and the plan asset credit in case of the with settlement. But let's suppose my liability was getting reduced by 10 million, but I paid only 8 million. This means that this settlement can even result in a gain, which should be taken to the P&L. And this settlement can even result in a loss if we overpay that amount. So the difference between the DBO and the plan asset will always be the gain or loss. This will always be the gain or loss on the curtailment and settlement. So the difference between the DBO and the plan asset will always be the gain or loss in the curtailment and the settlement. Getting this, everyone? Bongani saying, is it not significant change in the liability? Bongani, curtailment means significant change because of the reduction in the employees. The reason should be the reduction. Hannah has got it. Anybody saying past service costs can be defined as the pension cost of employee service in the past period. Not exactly, Ajmal. Hafiz is saying, please explain settlement again. Hafiz, settlement means that we are paying an amount to the employees. So we are crediting the plan asset. And DBO debit means the amount by which the liability is reduced. So the liability was reduced by 10, but we only paid 8 million. So this means that that was a gain of 2 million. So it is not necessary that we pay exactly the same amount by which the liability has reduced. So there can be a difference between both the amounts. So that is why we are recording a balancing figure in the P&L. Jesse is saying curtailment is the same as provision for restructuring. No, Jesse, I'm going to tell in a while about this. Hina is saying if we are paying more, Hina, in that case, we are going to debit the P&L over here that I've written. So if we are paying more, we debit the bank, the P&L. If we are paying less, we credit the P&L. Yes, Hafiz, that is the case. We are expensing out the balancing figure. That's how the gain or loss is going in the P&L. Yes, Jesse, if we are not paying any amount without settlement, then the P&L is basically representing the gain. Okay, now Imran is saying if the reduction in employees is not substantial, then what? A good question from Imran. We said that the substantial decrease is the amount of the curtailment. But what if the decrease is not substantial? Then we say that it's a past service cost. If the decline is not substantial, then we treat it as a past service cost. Okay, so let's continue. Yes, Hannah, we will be solving a question on this. So if I get back, so after curtailment and settlement, then we write the amount of the contribution that we have paid during the current year. So the contribution will actually increase the plan asset and the net will be a decrease in the net liability. Similarly, any amounts paid as a benefit will be deducted from both the values, the DBO and the plan asset. So the net impact is going to be zero. The net impact would be zero if we have deducted the amount from both the columns. Now, after that, by the year end, what we do is we actually calculate the carry down according to the present value of the new estimates, because the liability is an estimate. So ideally, we should be remeasuring the liability at each year end. So in the year end, the carried down should be the liability according to the new estimates, the revised liability. And this revised liability will result in a balancing figure, which can be positive, which can be negative, which is called the remeasurement gain or loss, which is going to be called a remeasurement gain or loss. Similarly, at the year end, the plan asset will be brought to its new fair value. So this will also result in a balancing figure being taken to the P&L. And this way we are going to have a net value in the carry down as well. Jesse is saying if I use gain or loss, do marker accepted? Yes, obviously, Jesse. Okay, Abdullah is saying, if there is a restructuring plan to change from defined benefit to contribution, and some employees were to be redundant and paid with others retained with an improved benefit contribution, does this entail past service? Not exactly, Abdullah, because in that case, the plan has actually changed. So when the plan has changed, so it should not be treated as a case of past service cost. Okay, so now concluding this accounting treatment, the interest cost, current service cost, past service cost, and the gain or loss on curtailment and settlement, these values are taken to the P&L. And we call this the service cost component. All these values are called service cost component, and the value of interest is called interest cost component. And both of these values are actually taken to the P&L. All of these values are taken to the P&L. And the value of the remeasurement gain and loss is called the remeasurement component, and this is what is taken to the OCI, other comprehensive income. Abdullah is saying when an entity changes from defined benefit to contribution, should the remeasurement gain or loss be recycled or de-recognized? Yes, exactly, Abdullah. We should be debiting the DBO, and we should be crediting the plan asset with the balancing figure taken to the P&L. Okay, yes, Jesse, exactly. This value, the value taken to OCI cannot be recycled to PNL. This cannot be recycled to PNL. So now let's have a question on this. So that we can apply the knowledge that we have gained onto the past paper question as well. So let me open the past paper questions. Cindy is saying at the end of IES 19, yes, Cindy, we will try to have the discussion over that. Jesse is saying that we don't want the question. Okay, Jesse. Okay, so here we have a question by the name of Kate that we are starting to discuss. It's one of the past paper questions, and this was of 5 marks, where we had to identify the plan as being either contribution or a benefit plan. It says that in its 2010 financial statements, Kate disclosed the existence of a voluntary fund established in order to provide a post-retirement plan to employees. Kate considers its contribution to the plan to be voluntary. So from Kate's perspective, the contribution is a voluntary contribution and has not recorded any related liability in its consolidated financial statements. Kate has a history of paying benefits to its former employees. So Kate has a history of paying benefits. The history actually creates a constructive obligation on Kate, even increasing them to keep pace with inflation since the commencement of the plan. The main characteristics of the plan are as follows. The plan is totally funded by Kate. So Kate is basically funding the plan. Contribution for the plan are made periodically. Post-retirement is calculated based on a percentage of the final salaries of the plan participants. So if we see, the benefit is not based on the plan asset, rather it is based on a predefined formula. So normally in such cases we call it to be a defined benefit plan, because this means that whether this amount is there in the plan asset or not, we actually have to pay that. So apparently it feels that this should be a defined benefit plan. Further, it says the annual contribution to the plan are determined as a function of the fair value of the assets less the liabilities arising from the past service. So that's something not important. Then it says that Kate argues that it should not have to recognize the plan because according to the underlying contract, this means we also have a contract, it can terminate its contribution to the plan if and when it wishes. The termination clause of the contract establishes that Kate must immediately purchase lifetime annuities from the insurance company for all the retired employees who are already receiving benefits when the termination of the contribution is communicated. So this means that even if we terminate the plan, we still have to pay the benefit in the form of the annuity, not in the form of the cash. Rather, we still have to pay the amount in the form of the annuity. So despite of cancellation, we can say that Kate cannot save itself from the outflow. So apparently we should be treating this plan as a defined benefit plan rather than the contribution one. Getting this, everyone? Cindy saying, can we say it's a settlement? No, Cindy. Settlement means that where we are actually removing them from the plan and instead we are providing them cash immediately. Ehsanul Karim is saying that what do we mean by annuity? Ehsan, by annuity we mean that the amount will be paid for a specific number of years, for multiple years. This means that the amount will be paid for multiple years. So if we write an answer to this question, Imran is saying it means that Kate have to pay anyhow from insurance. Exactly, that's what the point is. Cindy is saying that, so please repeat your last point. Cindy, the last point was that we have to pay the amount either either we pay the contribution or we purchase the lifetime annuity. So what we can say is that post-retirement plans are either classified as a defined contribution plan or as a defined benefit plan. In case where the company has no further obligation, no further legal or constructive obligation after paying the amount, after paying the contribution, and the investment and the actuarial risk belongs to the employee or third party. Such plans are treated as a defined contribution plan. In case of Kate, it has a history of paying benefits to the employees, which creates a constructive obligation on Kate to make such payments in the future as well. Further, as the benefit is not based on the assets in the fund, rather is a predefined formula, any difference between the amount of the formula and the plan asset is what Kate would have to pay from its own, which creates a liability even after paying the contribution. Therefore, should be treated as a defined contribution plan. Furthermore, there is an agreement and the termination, and as per the termination clause, Kate has to purchase lifetime annuities in case of termination. It has to incur an outflow either in the form of contribution or in the form of purchasing the lifetime annuities. So as Kate cannot save itself from the cash outflow, it should treat it as a liability. Jesse is saying how we can write such long answer in just 6 minutes. Obviously, Jesse, you cannot think the entire answer in the exam, so probably your answer will be a reduced one. By saying should be treated as a defined benefit plan. Okay, sorry, defined benefit plan. Dulai Singh, if a company agrees to pay £100 per month into the pension scheme, the last 2 months have yet to be paid. Should the full 12 months be recognized in income statement? Yes, exactly, Abdullahi, because we have to pay that despite it being a payable. So this was the answer that was supposed to be written in this question. Any questions in this so far? Angel wants the snapshot of the question. So let's go to the question. Here you go, Angel. Okay, so now we have another question that was asked in question number 1 of consolidation. And this is the statement that we are going to answer. You can take the snapshot, everyone, if you want it right now. Okay, Galaxy S8 wants a snapshot of the answer. Here you go. Okay, so now let's read the new question. Which says that Diamond operates a defined benefit pension scheme. On 31st March 2017, the company announced that it was to close down a division and agreed to pay each of its 150 staff of a cash payment of $50,000. So we have agreed to pay, we haven't paid yet, that we will be paying $50,000 to each of our 150 staff. So we can even calculate the total liability using these values. Now it further says, thank you, Imran. It further says that to compensate them for the loss of pension arising from the wage inflation. It is estimated that the closure will reduce the present value of the pension obligation by 5.8 million. Diamond is unsure of how to deal with the settlement and curtailment and has not yet recorded anything in the financial statements. So it's closing down a business division. So apparently we can say that as per IAS 19, in case where employees are reduced substantially from a plan, it is treated as a case of curtailment. In case of Diamond, it has closed down a business division. So the number of employees in the plan would be substantial. Therefore, shall be treated as a case of curtailment with settlement. Diamond should reduce the liability by how much? $5.8 million, and instead recognize a current liability. Yes, T. It is going to be treated as a current liability, but the amount that we are paying is because of the settlement by $7.5 million, which is 50,000 into 150 employees. This will result in a loss of how much? $1.7 million in the profit and loss account. So this is what was supposed to be the answer in this question. Any confusion in this so far? Randolph is saying, are you recognizing 7.5 in liability because it's not yet paid? Yes, exactly, Randolph. We are recognizing this because we haven't paid it yet. Imran is asking, sir, have you uploaded day 2 webinar on YouTube? Yes, Imran, I've already uploaded that. You can check over there. Okay, Siri has also written a similar answer. Siri wants to look at the question again. Go, Siri. Mohammed Ali is saying, which attempt is this? Mohammed Ali, this is June 2017 attempt. This is June 2017 attempt. Okay, Siri wants the snapshot of the answer. Here you go, Siri. No, Siri, exactly. We do not need to show the adjustment, actually. Randolph is saying, so what would be the entry one paid? Randolph, the entry is going to be bank credit and the liability debit. Bank credit and the liability debit when we actually pay that. Mohammed Ali, this is June 2017 attempt. Bongani is saying 7.5 million current liability will reduce the plan asset. Yes, Bongani, it will be reduced if we pay it from the plan asset. If we pay it from the plan asset, then the plan asset will be credited. You said today's agenda is IS 19, IFRS 15, and IFRS 16. Yes, T, exactly. Randolph, that the plan asset will belong to the company actually. Whatever is in the plan asset will belong to the company now. Hana is saying how 1.7 million loss. Hana 7.5 minus 5.8. So 5.8 was the actual liability, and 7.5 is what we are paying in return in exchange. Abdullah is saying why loss? Abdullah, because we are paying an extra amount. Instead of 5.8, we are paying 7.5. Okay, so let's do one more question relating to the calculation. Amandabi wants to move forward. Let's solve one of the short questions quickly, Amandabi. Okay, so here's a small question relating to Zippy. It says that the following information relates to Zippy's defined benefit pension scheme, where the net benefit pension scheme in the opening was 14 million. The service cost for the current year is 10 million. The contribution into the scheme was 8. We have two different discount rates. One is the opening, one is the closing. So we will be using the opening rate instead of the closing. The remeasurement gain or loss was 4, and the question says that no entries have been entered in the financial except for the contribution to the scheme have been correctly added to the pension scheme's assets. So now if we move the prepare the plan working in the OneNote. So we are solving the question of Zippy. Because the question has directly given us the net impact, so I'm also preparing the net liability directly. So if I read the question, it has given the opening net liability of 14 and then the service cost of 10. So we can say that the opening net liability was 17 and we should be having some interest cost on this. And then the current service cost was 10, which is going to be a positive in the net liability. The contribution were 8, so the contribution should be deducted from the net liability of 8. Then we had interest rates of opening and closing, so we'll be using the opening rate at 10% of 17, so it will be 1.7. And then we have the remeasurement gain. Gain means it will be a reduction in the net liability. So we are going to say remeasurement gain is a -4, so the closing liability should be how much? Okay, 14 is the net pension liability. So instead of 17, it is 14. Thank you. So the total is going to be 13.7. Yes, 13.7. So now if I make the accounting entry, I'm going to say that these two values should go to the P&L. 4 should go to the OCI and 13.7 should go to the statement of financial position as a non-current liability. So this is the accounting treatment that ideally we should be following in our answer. Okay, there are some questions. Let me quickly check. Okay, yes, the interest would also be 1.4 in this case because we have changed the value. So it's 1.4, so the total closing value will also be 13.4 in that case. Imran is saying 14 minus 37 point. Imran, the net liability that will go in the balance sheet is 13.4. Yes, Abdullah, it is possible for the companies to maintain both the plans. There's no issue in that. Abdullah Mekaljo is an easy question. Hannah saying, how do you calculate 1.4? Hannah, the simple is 14 million into 10%, that's 1.4. That's the simple working. 14 million into 10% is the interest cost. Galaxy S9 is saying, is it not the difference 14 and 13.4 that should go to NCL? Basically, if we are making an accounting entry, then we can say that the P&L should be debited by 11.4, which is 10 plus 1.4. The OCI should be debited by 4. Sorry, OCI should be credited by 4 because that's a gain. This 4. The bank should be credited by 8 because the amount that we have paid. And the non-current liability when we are making the entry should be a debit by 0.6. So in the accounting entry, we are going to debit the non-current liability by 0.6. But in the balance sheet, the value that will go is 13.4. So we should be clear on this, that what amount goes to where. No, Yusra, we have financial instruments and IS 12 in tomorrow's session. Angela is saying, please, is this the 0.6 the balancing figure? No, Angela, the 0.6 is the difference between 14 and 13.4. Okay, so let's start the next accounting standard now. Yes, Bibi Fatima, it's the same time. Now let's discuss the topic of IFRS 16, which is leases. Thank you, Abdullahi. Now, when we talk about IFRS 16 leases, we have to learn 3 impacts. How to identify that whether it's a lease contract or not. Second, the accounting for lessee. And third is the accounting for the lessor. So these are the three areas that we are going to learn in the topic of leases. Let's start from what exactly is a lease. How do we identify the contract, whether it's a lease or not? This is the first area that we are starting. Now, basically what exactly is a lease? Lease is a case where a company, where let's say A transfers the right to use of a specific asset to another entity in return of consideration for a specific period of time. For a specific period of time. Now, this is what is called a lease contract, where one party transfers the right to use to another party for consideration. Now, if we see the important areas in this, the first thing is the right to use. Now, so we say that the right to use shall be an unconditional right. This should be an unconditional right. Any condition should not be there, or there might be any condition, but that should not affect the lessee's use. So the right to use should be unconditional, or any condition that does not affect the use of lessee. That is what is called the right to use. Second thing is the specific asset. The specific asset means the lessor should not be able to replace the asset. Lessor should not be able to replace the asset. That is what is meant by the specific asset. So in case of lease, we say that there should be a specific asset and the right to use should be transferred. Jesse is saying ROU is present in investing activity. What's ROU, Jesse? It's right to use, RTU actually. Jesse, right to use is not classified in the CFI because we do not pay the cash for this. So because we are not paying any cash, that is why we are not going to treat it as a part of the cash flow statements. Okay. So now the third criteria is the consideration, that there should be a consideration in this case. So if there's no consideration for the lease agreement, then we do not consider it to be a lease. In this case, we call the A as the lessee and we call B as the lessor. Now, if we discuss the lessee accounting, the lessee has to perform three types of accounting. Okay, sorry. A is going to be called the lessor who's providing the asset on lease, and B is going to call the lessee. Sorry for that. A is the lessor who's providing the asset on lease, and B is the lessee who is receiving the asset on lease. I mistakenly said the opposite. Okay, so now let's start the lessee accounting. In lessee accounting, we need to discuss the lease accounting. We need to discuss the lease exception, and we need to discuss the sale and lease back. These are the three areas that we need to discuss. Now, starting from the lease accounting, in the lease accounting, the lessee is receiving the right to use of the asset. So we are going to debit the right to use asset, and the lessee is taking a responsibility to pay cash in the next years. So we record the right to use asset and we record a lease liability. Lease liability is the obligation to deliver the cash to pay the lease rentals. So we are debiting the right to use and we are crediting the lease liability. Apart from that, there might be some rentals that the company would be paying in advance. So the first thing, this entry will be recorded by the present value of all future lease payments. Hannah is asking, in which books are we? Hannah, we are in the lessee's financial statements right now. So we are talking about lessee's perspective. Now, the lease liability and the right to use are being recorded by the present value of all future lease payments. Apart from that, if there's any amount that we have already paid, we are going to make another entry as the right to use asset debit and the bank credit. So this is for the lease payments which we have already paid. And obviously, when we are leasing an asset, we might incur a direct cost on that cost to bring the asset into the usable condition, like any transportation cost, any installation cost, any testing cost. So these types of costs should also be capitalized. So any initial direct cost will also be capitalized by debiting the right to use asset and crediting the bank. Plus, if the asset is of a type of an asset which needs to be dismantled at the end of its life, so we should also be recording a provision for dismantling against this, which should be recorded in accordance with IAS 37 by the present value of the dismantling cost. So all these costs will actually be capitalized in the right to use asset. Now, if let's suppose the lessor is giving an incentive, DC means dismantling cost. This is the dismantling cost. Now let's suppose if the lessor is giving an incentive with the lease, what entry will we make in that case? So we say that in case of incentive, we are going to debit the incentive as an asset, and we are going to credit the right to use asset, because we assume that the amount of the incentive has been charged along with the asset in actual. So because it is already charged in the right to use asset, that is why we are going to deduct that amount from the right to use and record it as a separate intangible asset, as a separate asset, sorry. So the asset will be debited as an incentive and the credit is going to be the right to use asset. Any confusion in this? Okay. The last thing is the incentive. Actually, let me repeat that. Basically, what exactly is an incentive? Incentive means that, let's suppose if you take a car on lease from me, I will give you a tire free. So the tire is an incentive on the lease of a car. So sometimes the lessor actually gives the lessee an incentive to promote the lease agreements. So that is what is called the incentive. So let's suppose we are getting a tire as an incentive. So we should be debiting the tire as a separate asset. And we assume that the cost of that tire would have been charged in the right to use asset. So that is why we credit the right to use and debit the incentive that we are getting. Getting this, everyone? Okay, now people have got it. Okay, now we have discussed the accounting mainly for the year 0 so far. Now what about the later years? In the later years, the lessee should be paying the lease rentals. So the bank is going to be credited in the later years. And against that, we are going to debit the finance cost and the lease liability. So every year, the rentals that would have been paid will include both the elements, the finance cost and the lease liability. Now, the finance cost will be recorded by the implicit rate by the lessee. Lessee will recognize the interest expense by the amount of the implicit rate. Now, what is an implicit rate? Rate charged by the lessor. Now, what if the lessor has not informed the lessee about the rate that it is charging exactly? What about that case? So we say in case where the lessor has not informed the implicit rate, in that case we use the incremental borrowing rate. We use the incremental borrowing rate of the lessee. We can call that a lesser rate as well. Now, what's an incremental borrowing rate? Incremental borrowing rate is basically rate charged to the lessee if, or we can say on loan, on the same amount of the lease liability. So if lessee would have gone to take a loan by the same amount of the lease liability, what rate would have been charged by the bank? That rate is what is called the incremental borrowing rate. So we actually assume that the lessor would also be charging approximately a similar rate to what any other bank would have charged on a loan of the same amount. So the lessee should calculate the interest expense based either on the implicit rate or on the incremental borrowing rate. Plus, the lessee should also charge the depreciation expense of the right to use asset. So the depreciation expense will be debited and the right to use will be credited. Okay, Jesse, thank you. So in this case, we are going to charge the amortization expense as the depreciation expense debit and the right to use asset credit. Now, over what life should we charge the depreciation expense? So in this, we say that the depreciation expense should be the right to use asset minus the residual value divided by the useful life. And the useful life is normally the lower of the life of the asset and the lease term. So whatever is lower is going to be the amount of the lease life of the useful life. Getting this, everyone? Sarah is saying if you repeat the incremental borrowing rate, Sarah, incremental borrowing rate means the rate that if the lessee goes to, let's say, any bank and asks for the loan of the same amount as the asset taken on the lease, then what exact rate the bank would charge? So the rate that bank actually charges is called the incremental borrowing rate. Yeah, Alexius 9 is saying how would the bank know the rate? Obviously, the bank would calculate the rate. The bank will calculate the rate before um, letting the lessee know it. He is saying, when are we taking the break? We are taking the break in a while exactly. Sarah is saying if implicit rate is not given, then we use the incremental borrowing rate. Exactly, Sarah. You have got it right. Galaxius 9 is saying, what circumstances would the implicit rate not be used? There's only one circumstance that the implicit rate is not known. The lessor has not informed us the implicit rate. Only in that case we take the incremental borrowing rate. Okay, so now we have Hannah is saying, is it important to watch mind of marker or we can skip due to time shortage? Hannah, in the exam, you have to think less and write more, because most of the time when the students think a lot, they are going in the wrong direction. Because sometimes the question is simple and we try to think there would be something confusing in this, and we intentionally make the question confusing for us. So it's always better um, to think less and write more, because whatever comes in your mind first, start writing about that. So obviously we have to think. It's not that we don't think anything and we simply start writing, but we don't have to invest too much of the time on thinking and planning and looking what the confusion could be. So let's take a break, everyone, and then we will be continuing in 20 minutes time around. So let's have a 20-minute break and then continue back with the IFRS 16. Kenya is saying investment in property IS 40 is a non-financial asset or determine its fair value as per IFRS 13. Why do you know? Kenya, your question is something different. So let's discuss that later. Harun, I have seen your message. I will be replying it to you probably today or tomorrow sometime. So just wait for a few more hours and you will get a reply on that. Okay, everyone, welcome back from the break. Mandeep, the actuarial gain or loss is basically the remeasurement gain or loss. In other words, we can call it the remeasurement gain or loss. Okay, so now we had discussed about the lessee accounting before the break. Now the next area that we are going to discuss is going to be the lease exception. Now what exactly is a lease exception? Basically, the accounting that we have just discussed is one of the complex accountings. So the standard allows an easy alternative accounting in two cases. In case of a short-term lease and in case of a low value asset. So in case where the lease is less than or equals to 12 months, we call that a short-term lease. And in case where the cost of the asset is less than or equals to $5,000, we again call that a low value asset. So in these two cases, we actually simplify the accounting rather than applying such a complex accounting. We apply the accounting of the lease exception. So it's more of simplifying the accounting. Now, in these two cases, an alternate lease accounting is allowed. That is to simply recognize the lease payments as an expense. So we say that the lease payments are recognized as an expense on the straight line basis. So in case of lease exception, we simply recognize the expense on the straight line basis. So whatever the lease payments are, we can simply say expense is equals to all lease payments divided by the lease term. So that's how simply we account for in case of the lease exception. Okay. So now the third area is the sale and the leaseback. Yes, exactly, Ganya. It includes that amount as well. That is why we have said all lease payments, irrespective of the name, all types of lease payments have the same accounting. Okay, so now the next area that we are discussing is the sale and the leaseback. That's comparatively an easy one. So in case of sale and leaseback, the accounting is pretty simple. First, we recognize the entry for the sale, which is the bank debit and the asset credit, with the balancing figure taken to the P&L. This is a normal entry that we recognize in case of the sale. Now, because we are not only selling the asset, plus we are buying it back as well. So we are going to make another entry within the same, which is the right to use debit and the lease liability credit. So in simple words, we have only merged the accounting entries of the sale and the lease in a single entry. Now the bank is going to be debited by the amount of the sale proceeds. The asset is going to be credited by its carrying amount. The lease liability will be recorded at the present value of all future lease payments. And the P&L is going to be the balancing figure. Now, the only complex value that we need to calculate in this is the right to use asset. At what amount the right to use asset will be recorded. So in this case, we say that the right to use asset should be recorded by the carrying amount into the percentage of the asset retained. The percentage of the asset retained. Now, because we have sold the asset and then leased it back, we have first sold the asset and then we have leased it back. So this means we have not sold 100% of the asset. In short, we haven't sold 100% of the assets. In short, so how much percent have we sold and how much percent have we retained? Now the calculation for that is quite simple, that we say that the percentage retained is the present value of lease payments, whatever amount we are paying, the present value of that, divided by the fair value of the asset. Present value of the lease payments divided by the fair value of the asset is simply the value that we have retained. Because this is the percentage that we are paying out of the fair value. So whatever percentage we are paying should belong to us. So that's how we calculate the percentage of the asset that we have retained. So whatever percentage we have retained, okay, the screen is not updating. Just a minute. Let me stop sharing and let me reshare again. Okay, just give me a minute. There's some problem in the internet connectivity. Okay, so we were discussing that whatever percentage we are paying, the amount that we have paid divided by the fair value is actually the percentage of the asset that we have retained. So that's the simple method of calculating the value. So any confusion on this? So we have discussed the lease accounting, we have discussed the lease exception, and we have discussed the sale and lease back. Cindy is saying, can we have any of the word example? Yes, Cindy, let's have an example. Like let's suppose we had an asset So we had an asset of, let's say, $80 million, which had a fair value of $100 million. And the present value of the lease payments that we will be paying is, let's suppose, $60 million. And we have sold the asset at the fair value. So we can see that the sale proceeds and the fair value are the same. Now we need to prepare the entry for the sale and lease back. So we are going to say simply bank debit by the sale proceeds of $100 million. Asset should be credited by the carrying amount of $80 million. The balancing figure of the entire entry will go to the P&L. The right to use asset debit and the lease liability credit, lease liability will be by $60 million. And the right to use should be by the carrying amount of 80 into 60 divided by 100. Divided by 100 because of the fair value and multiplied by 60 because of the present value. So if we calculate it that way, the right to use asset is going to be $48 million. And this way we're going to get a balancing figure of $8 million, which should be taken to the P&L. So that is the simple accounting that we should be doing to calculate the gain or loss on the disposal. Getting this, everyone? Okay. Bharat is saying that what if the sale value is not the same as the fair value? Then in that case, Bharat, the difference will become a financial liability or a financial asset. Mudassir is saying that there's some interruption. Mudassir, what type of interruption in the voice? Okay, is it okay now, Mudassir? Is the voice better now? Okay, that's great. Okay, now let's discuss the accounting from the lessor's point of view. Now, when we talk about the lessor, we say for the lessor, there are two types of lease. One is the finance lease and the other is the operating lease. The lease accounting of lessor still has the finance lease and the operating lease. Now, in case of the finance lease, we need to discuss two types of accounting. The accounting for the manufacturing lessor and the accounting for the non-manufacturing lessor. Now, the accounting for the lessor is simply the opposite of the lessee. The accounting for the lessor is simply the opposite of lessee. The lessee was receiving the right to use asset, the lessor is delivering the asset. So ideally, let's start from the non-manufacturing one. So ideally, the accounting for the non-manufacturer is going to be the finance lease receivable debit and the asset credit, with any balancing figure taken to the P&L. So the asset should be credited by the carrying amount of the asset, and the P&L should be simply the balancing figure. Now, what about the finance lease receivable? So we say that the finance lease receivable should be recorded at the net investment in lease. Now, what is the net investment in lease? It is the present value of the gross investment in lease. And what is the gross investment in lease? For this, we say this means lease payments. In short, all of the lease payments that a lessor would receive is what is called the gross investment in lease. So although the wordings are technical, but in simple wordings, we can say it's simply the present value of all lease payments, because that is what at which the lessee recognizes the liability, and that is what at which the lessor should recognize the asset. So ideally, there's no much difference between the lessee and the lessor's accounting. The lessee is recording a liability, the lessor is recording an asset, and both of them are recording it at the present value of the all lease payments. HANA FLR means the finance lease receivable. Finance lease receivable. The amount for which we have a receivable. Now, this is the entry that we have made for year 0. In the later years, year 1 and onwards, every year the lessor will receive the rentals. So the bank should be debited. And the lessor is receiving two types of amount. One is going to be the interest income, and the other is going to be the finance lease receivable. These are the two values by which the asset should be, the entry should be made. Okay, just give me a minute. I'm changing the internet. Is the voice better now? Okay, so now let's resume. We were discussing that every year the lessor is going to receive the rentals by which the lessor will be debiting the bank. The interest income will be credited by the implicit rate, and the principal amount that the lessor has received will be the one by which the finance lease receivable will be credited. Now, when we talk about a manufacturing lessor, the entry is quite similar, that the manufacturing lessor will also debit the finance lease receivable, but the manufacturing lessor will not be crediting the asset because for the manufacturing lessor, it's an inventory. So ideally, the manufacturing lessor should be crediting the sales. So the entry will be finance lease receivable debit and the sales credit. The entry would be the finance lease receivable debit and the sales credit. Now, by what amount the entry is going to be made? Apart from this, we have to make another entry as the cost of sales debit and the inventory credit. Because whenever we record the sales, we also record the cost of sales. So this is the complete entry that should be made. Now the finance lease receivable should be debited by the same net investment in lease, which means the present value of all lease payments, while the inventory will be credited by the amount of the cost. Now, when we talk about the sales will be recorded by the present value of the lease payments, and the cost of sales will be debited by the cost. But we say that the cost of sales should deduct amount received. NIL means the net investment. This means the net investment in lease. So from the cost, we also deduct any amount to be received from any third party on the disposal, which is also called the unguaranteed residual value. The amount that we are expecting to be received from any third party when we sell the asset on the completion of the lease. So that is in short called the unguaranteed residual value. Cindy is saying, sir, an example. Cindy, let's suppose that there was an asset with a life of 5 years. Now, the lessee wants the asset on lease for, let's say, 4.5 years. Now, being a lessor, I asked the lessee that you should take it for 5 years entirely because it's of no use after 4.5 years. Nobody else would buy it from me or lease it from me for only half of a year. So the lessee gives a guarantee that if nobody buys, I will buy it for $1,000. The lessee gives a guarantee that if no one buys, I will buy it for $1,000 after 4.5 years. And the lessor expects the residual value to be value is going to be how much? $500, which is 1,000, which is 1,500 minus $1,000. So in short, we say that we should be deducting cost minus the unguaranteed residual value while recording the cost of sales. Getting this, Cindy? Okay, good. Anna wants the snapshot of this part. Ganya saying net investment lease and present value of lease payment is the same. Ganya basically, the net investment in lease means the present value of rentals plus GRV plus UGRV. And over here, the sale is recorded at the present value of rentals plus GRV only because UGRV is something which has been taken to the cost instead. So because we have taken it to the cost, that is why we do not add it in the sales. Now again, this is the entry that we had made for year 0. So for year 1, we are again going to receive the rentals for which we are going to debit the bank and again credit the interest income and the finance lease receivable. But the only difference is that the manufacturing lessor should recognize the interest income at the market rate. The manufacturing lessor should ideally be recognizing the interest income at the market rate instead of the implicit rate. So this is the only difference between the manufacturing and the non-manufacturing when we talk about getting this one. Okay, so now let's continue and we're going to solve one of the past paper questions now. Cindy saying present value of lease payment means, Cindy? Cindy can't see the screen. Let me share again, Cindy. Means present value of the rentals, GRV and the UGR. Got it, Cindy? Okay, so now let's get back to the question. And the question is about the lease accounting, about the identification of the lease. So let's start reading it. The question says that while searching for some invoices, the accountant found a contract with calendar, which calendar had entered into on 1st January 2027. So this is the date when we have entered into the contract. Now this contract is basically with Diary, another entity. The contract allows calendar to use a specific aircraft owned by Diary for a period of 3 years. So this is a specific aircraft which is for 3 years, and calendar is required to make annual payments. So apparently the criteria for the right to use is being met, apparently. Cindy is saying, what is year? Cindy, year means year. I haven't written YR anywhere. Okay, of the question you're saying. Okay, you are asking what year it actually belongs to. Cindy, this actually belongs to September 18 exam. This belongs to September 18 exam actually. Okay, so now the question says that on 1st January 2087, which is the date of the contract, costs were incurred negotiating the contract. Costs were incurred negotiating the contract means that this is the transaction cost. So this means this is the cost of the initial cost. So apparently this cost should be capitalized in the right to use asset. The first annual payment was made on 31st December 2087, which means the year end. Both of these amounts have been expensed to statement of P&L. So that's incorrect. So when we have taken the asset on lease, we should ideally be capitalizing this cost, and in the annual payment we should be calculating the finance cost and the lease and the principal repayment. There are contractual restrictions concerning where the aircraft can fly. So this means that the contract also applies the conditions on us. Subject to those restrictions, calendar determines where and when the aircraft will fly, and the cargo and passengers which will be transported. So this means there are certain restrictions, but we need to check whether those restrictions are affecting the use of calendar or not. If they are they are affecting, then this contract is not a lease contract. And if they are not affecting, then we are going to say it's a lease contract. Diary is permitted to substitute the aircraft. That's again an issue. Ideally, the lessor should not be able to substitute the asset at any time during the 3-year period for an alternative model and must replace the aircraft if it's not working. Any substitute aircraft must meet strict interior and exterior specifications outlined in the contract. There are significant costs involved in outfitting an aircraft to meet the calendar specifications. So apparently, we can say that Diary has the right to replace, but because of these strict interior and exterior specifications and the significant cost involved in it, we can say that the Diary would not replace or substitute the aircraft. So it legally has the right, but in substance, it will never exercise its right. So based on this, we can say that this contract is a lease contract. The accountant requires advice as to correct accounting treatment of this contract. Okay. So now let's write down the answer on a new page. So we can say that as per IFRS 16, lease is a contract where the lessor transfers the right to use an asset to lessee, a right to use a specific asset to lessee against a consideration for a specific period of time. In case of calendar, it has the right to use the aircraft, but diary has certain restrictions on where the aircraft can fly. Apart from those restrictions, calendar can decide on its own when and where the aircraft fly. So apart from the restriction, calendar has the right to use the asset. However, if the restrictions are significant enough to affect the use of calendar, in that case, the contract shall not be classified as a lease contract. Further, diary can also substitute the asset, but there are strict conditions from calendar which would involve significant cost. So apparently, diary would never want to replace the asset. Therefore, the contract should be treated as a lease contract. As the lease term is 3 years, it is not a short-term lease, and the cost of the aircraft is also not low. Therefore, the rules of lease accounting should apply, where the present value of all lease payments, all future lease payments should be capitalized in the right to use asset and recorded as liability, with any initial direct cost being capitalized. Therefore, calendar should also capitalize the cost incurred to bring the asset into usable condition. Furthermore, the lease payments shall be recorded partly in the finance cost using the implicit rate if known, or incremental borrowing rate. The difference between the finance cost and the rentals being treated as a repayment of lease liability. So that's the entire answer, what was supposed to be done in this question. Gania is saying, but there's a restriction on the use of the asset. Gania, we have mentioned it that if the restriction is significant enough, then it's not a lease. Mudassir is saying that if the restriction does not make it lease, then the accounting treatment would have been correct. Mudassir, then the treatment currently done by the question would have been correct. Okay, Sarah wants a snapshot of the answer. Sarah, here you go. Okay, so here's the snapshot of the question as well. You can take the snapshot of the question. Okay, the exam is basically specimen exam 2. Sorry for that. This question of the calendar is from specimen exam 2. Angela, the expensing will be okay. Okay, Imran, you will receive that. Okay, so that was all about the topic of IFRS 16 leases. Now let's start IFRS 15. Oh yes, we have left the operating lease. Thank you, Josie. So let's discuss the operating lease quickly. The treatment of operating lease is quite simple. Then the operating lease is simply just like the lease exception. So we recognize the lease payments as an income. So whatever the lease payments we are receiving will be recognized as an income on a straight line basis. So we can say that the income is equals to all of the lease payments or the lease receipts, we can say, divided by the lease term is what the lessor is going to recognize as an income. So the treatment is quite similar to the lessee's lease exception. Now, how do we identify whether the lease is an operating lease or a finance lease? Okay, Lippy is saying, thank you, Lippy. Before end of the class, please let us know tomorrow's question that you are going to solve. Okay, Lippy. Now, how do we identify that whether the lease is an operating lease or a finance lease? Now, the answer for that is quite simple. No, Josie, you don't need to study IAS 70. Studying IFRS 16 would be enough. So basically, we say that the lease is a finance lease in the following cases. So in which cases? In the following cases. Now we say that the first possible case is that the asset is transferred to lessee at the end of the lease term. So if the asset will be transferred to lessee at the end of the lease term, then we call it to be a finance lease. Then we call it to be a finance lease. Similarly, if the lease term relates to the major part of the life of the asset, then also we say that it is a case of a finance lease. Now, when we say major part, this actually means that the lease term is more than or equals to 75% of the life. So if the lease term is more than 75% of the life, then we call it to be a finance lease. Third is that the present value of the lease payments substantially cover the fair value of the asset, which again means the present value is more than or equals to 90% of the fair value. So if the lessee is paying approximately 90% of the value, then the asset is mainly belonging to the lessee as well. The fourth point is asset is of a specialized nature that no one other than lessee can use the asset without modification. So if no one else can use the asset without modification, then we are going to say that it's a case of finance lease because that asset belongs to the lessee. That's why no one else can use it without the modification. And the last part is that the lessee has an option to purchase the asset at a value below the fair value and it is probable that lessee will exercise the option. In other words, we call this a bargain purchase option. So in this case as well, we call it to be a finance lease. Abdullah, it's very difficult to prepare a guest exam paper, obviously, because it's not possible to guess the examiner. They bring new cases from the industry, from their practical experience. So that's why it's really difficult to get a prediction of the exam paper. Okay, the audio is here, Hannah. Josie is saying an operating lease, if an asset is not transferred, how can lessee recognize it as asset? Josie, basically, um, the answer is quite simple to this, that lessee is not recording the asset. The lessee is recording the right to use of an asset. The lessee is saying that I have the right to use this asset. Lessee does not owns that asset. So there's a huge difference between owing and getting the right. So Josie has got the point. So thank you everyone. Today we completed two important standards. One was IAS 19, the other was IFRS 16. I hope the session was useful for you people. And tomorrow we are going to have the last session for the revision classes on Saturday, same timing, 8 p.m. to 11 p.m. So I'm looking forward to meet you all over there. Bharat is saying, sir, are these cumulative conditions or it's anyone? Basically, anyone. Bharat, if any one of the condition meets, we call it a finance lease. Yes, Cindy, we'll cover IFRS 15 for sure. Yes, Mohammed Lamin, will not forget to upload it. Sarah, IFRS 2 is available in the previous recorded sessions of the webinars. You can refer to over there. Tanya is saying when we answer this investment property as what is a non-financial. Gania, let me answer this question tomorrow sometime. So thank you everyone. Looking forward to meet you all tomorrow. Till then, take care and Allah Hafiz.